Last week, I had one of those conversations that was meant to go in one direction and ended up going somewhere even more interesting. I was speaking to Jack Rogers, co-founder of Keychain. Now, Keychain is a smart piece of kit, and we'll come on to that. But what really caught my attention was Jack's background. You see, Jack is an LSE economics graduate. He worked at the Bank of England as an economist, and he has a deep understanding of the economics that sit behind the mortgage market. So this became more than a conversation about technology. It became a chance to unpack some of the forces shaping the market all around us. And we begin with a question that sounds technical, but matters hugely. What is an interest rate swap, and why should anyone in mortgages care?
Have you ever played this?
I've never played Monopoly Deal, no, but hang on a minute, just hold this up because this could be interesting to our audience. So Jack Rogers, you are a trained economist. And so what you're saying is in your spare time, this is what you do. Hold that up again.
No, this is what my wife likes to play on holiday.
Monopoly Deal, do you play it for real money?
No money, mainly just...
But who wins? And are there any arguments? Because I've had more than one argument over the years of playing, full-size Monopoly.
There are there real arguments? There's one, it's not to get too technical in the rules of Monopoly Deal, but there's one kind of grey area in the official rules. Like we've played it with some other couples before, and there's one kind of key point which the rules aren't clear on. So that can be a bit of an argument, but no real arguments on Monopoly Deal.
Do we leave the audience guessing for what?
Yeah, it's actually kind of it's quite a niche bit of the rules. And it would take quite a while to explain. So
if anyone wants to know, they can just contact you directly at Keychain.
Yeah, okay. Exactly.
All right. Exactly. Well, on that note, so let me welcome you, Jack. It's great to have you here, Jack Rogers, co-founder of Keychain. As I've said in my introduction, we started to have a conversation that was interesting in the first place, and that's how we'll finish our conversation today in respect of Keychain, what it is, how it can help brokers and clients. But then what really got my curiosity going was the fact that you are an LSE economics graduate and you've worked at the Bank of England with very much a mortgage pricing sort of function and remit, yes?
Yeah, that's right. Yeah, so the division I worked in, so I was an economist at the Bank of England. The division I worked in was very much focused on UK banks and their lending and how monetary policy impacted their lending. The biggest area of lending is mortgages in the UK for the kind of big six banks. So spent a lot of time looking at kind of the factors that influence mortgage pricing and ultimately kind of rates to consumers.
Yeah. So we're going to sort of loop back on the influencing factors. But what I want to know, and I know so many brokers would like a more sort of detailed understanding of, is what are swap rates and how do they actually factor into the mortgage market?
Yeah, so swap rate is the clue's in the name, but what it's actually swapping is flows of interest rate payments. So in a swap, you've got two legs. You've got the kind of fixed leg and the floating leg of the swap. What I mean by floating is it's kind of variable. So swaps between two parties. So say you and I were looking to do a swap transaction. Mm-hmm. One of us would agree to pay whatever the kind of short-term floating rate is. So that's commonly SONIA. So that's the kind of sterling overnight rate. So that's very close to the Bank of England rate. So I'd agree to pay you SONIA for the length of the swap. So that could be 2 years, it could be 5 years, it could be 3 months. And then you'd agree to pay me not SONIA, but some fixed rate. So I'd essentially be paying you whatever that SONIA rate is, and you'd be paying me some fixed rate for the entire length of the swap. So if the swap rate itself is what the pricing of that fixed leg is. So if a 2-year swap was at 2%, and we were kind of entering into that swap, I'd pay you SONIA, again, which is very close to bank rate, for 2 years. Whatever the bank rate does, right, it could go up, it could go down, it could go up a lot, it could go down a lot. And you'd paid me a flat 2% for 2 years. So that's kind of what a swap is. It's essentially a kind of tool that's used to move kind of or change the profile of interest rate risk for the two counterparties.
So who essentially is actually taking that risk, and how does that then factor into fixed rates? Because essentially that's what we're looking at, aren't we? We're looking at the 2-year SONIA swaps and the 5 years. That's generally what we tend to look at.
Exactly. Yeah, so to think about how it kind of factors into mortgage pricing is, if we think of UK banks and particularly kind of like the I guess the main residential banks, the big six and other building societies, they're primarily deposit funded. So if you think of their balance sheet, on the asset side, they're making loans, they're earning interest from those loans to customers, right, from mortgages. And on the liability side, they've got depositors and they pay those depositors interest. You kind of start with the liability side, funnily enough. So the liability side is what's called behaviorally floating. So what I mean by that is, with regards to interest rates, what we mean by that is that when the interest rate goes up, say the bank rate was 3%, I might be paying my depositors 2%, right, on those deposits. If the bank rate went up to 8%, I would have to pay those depositors more. I'd have to pay them 6%, 7%, but I'd have to pay them more. And if I didn't increase the interest rate that I pay to depositors, then they might move their deposits to other banks, right? And I'd have this big deposit outflow, and then I'd have to sell some loans and so on. So the deposit side of the bank's balance sheet moves around with interest rates. And that's what we mean by behaviorally floating. Now, on the asset side, the majority of mortgages in the UK are fixed rate now. So around 80% of mortgages are fixed rate. So what banks want to do is actually transform that asset side of the balance sheet to also be floating. So what they do is they pay the fixed leg of the swap and receive the floating leg. So what that means is they now are receiving the floating payment, so something similar to SONIA. And if in the future interest rates were to go up or interest rates were to go down, then they'd get that pass through on the asset side to match the increase they have to pay on the liability side. So that's what banks are doing. It's essentially they're writing the fixed rate mortgage, taking the swap rate, paying that away to receive the floating rate, and then that kind of better matches the liability side of the balance sheet. And why that's really important is it means that the banks, and it kind of comes from the regulator, is the regulator doesn't like banks taking interest rate risk. So what the regulator wants is the bank to be stable. If interest rates go up, interest rates go down, that they're not kind of left in a position where they're losing money. So that's kind of the dynamics for fixed rate mortgages for deposit funded banks in the UK, which is, the kind of core bit of the market.
And you have to pay a fee for that privilege, do you not?
So the fees kind of and the premiums kind of baked in within the mechanics of the swap itself. So it might be that the banks are paying the person who's typically who's receiving the fixed part of the swap might charge a premium for the fact that they don't have that risk of interest rates moving around, right? So it's kind of baked into the pricing that there's some additional risk that, say for example, interest rates were to go to 10% overnight, that the person who's paying the floating leg would have to pay 10% while they might only be receiving 2 or 3% on the fixed rate. So yeah, that is kind of baked into the pricing.
And who actually does the pricing? Is it internal economists? Is it purely driven by market forces? How does that work?
So market forces is what it's driven by, much in the same way kind of like for any other financial markets, stock prices or bond prices. It's basically where supply meets demand. So in certain periods where, and kind of similar to the one which we might be in the moment, at the moment, where a perceived side of the transaction might be more risky, then swap rates can jump up to reflect the fact that no one really knows, or the path of inflation is a lot more uncertain, and hence the path of the bank rate and SONIA is a lot more uncertain. So there's an extra premium for those swap rates at the moment. So yeah, it's kind of market driven pricing. It isn't set by kind of one person or individual institution.
So the more volatile interest rates are, then the higher that premium would be, I suppose.
Yeah, you'd expect a higher premium where there's more uncertainty around the path of SONIA. And I kind of am using SONIA and bank rate interchangeably. SONIA is basically the market rate version of the bank rate, but it's very, very close to bank rate. But yeah, you'd expect a premium where there's some uncertainty in that market and it needs to be priced in. So you need to kind of, the people who are paying the floating leg want a higher swap rate to compensate them for that risk of potentially having to pay a higher floating leg in future.
And so that's why we need to keep our eye on the swap rates, because that will fundamentally determine what fixed mortgage rates are going to then transpire into the marketplace. Yes?
That's right. Yeah. So swap rates are kind of one of the key factors in mortgage pricing at the kind of different durations. I think that's kind of commonly misunderstood, is the link between bank rates to swap rates and then ultimately mortgage pricing. And I think there's the kind of, they are kind of obviously related. But the kind of one-for-one relation that's evident in kind of variable rates or tracker rates isn't as strong in fixed rate mortgages, because you do have this added thing of the of how bank rate transmits to the swap market, which then once swap rates have moved, then goes into ultimate mortgage pricing. So as an example, right, we haven't seen bank rate move at all over the last month since the start of the Iran conflict. But we've seen swap rates move a lot, and that's impacted mortgage pricing and also availability of mortgage products.
And in layman's terms, then, essentially, when you're pricing a swap, you're almost trying to be a fortune teller, to actually have an understanding of what the interest rate movements will be over a certain period of time.
Yeah, so there's something called the essentially swap implied path of bank rate. So you can look at swaps at different durations and kind of mathematically solve back out what that implies for bank rate at the different maturities. And the Bank of England actually published that. If you search Bank of England yield curves, they publish what's called, I think it's like the nominal instantaneous overnight curve, but it essentially shows you what the market thinks the path of bank rate's going to be. But you can essentially, if you have that kind of constructed, you can back out from that what the swap rate would be to make both sides to essentially make the current market pricing fair, if that makes sense.
What are the key things that actually do influence the pricing of the swaps that ultimately leads through to mortgage pricing?
Yeah, so the main thing is that path of bank rate, and taking one step back from that, the key thing which drives the path of bank rate is the expected inflation path. So where you have events which impact factors of inflation. So for example, in the Iran conflict, the impact on energy prices has already directly impacted the price of diesel and petrol at petrol stations. But then that has a kind of much wider impact on the whole economy and can bleed into kind of core inflation because of the impact on essentially everything in the economy is related to or has some reliance on energy prices. Food needs to be moved around, and that's kind of related to petrol prices. But the path of expected inflation will have a direct impact on the path of expected bank rate, because obviously bank rate is the tool which the Bank of England and the Monetary Policy Committee use to return inflation to target of 2%. So whenever inflation's above 2%, it's very likely that the base rate increases to return it back to base rate, to the 2% target. So that's kind of the things which when you see an increase in expected inflation, you'll see the expected path of bank rate move, and then that has that impact on swaps, because now when the market's looking at, or when the market pricing is being constructed, it will kind of look at, okay, now we've got this path of inflation, so obviously the swap rate needs to move up to reflect that.
What factors influence mortgage spreads?
Yeah, so spreads are essentially the bit on top of the swap rate that is the difference between the headline rate and the swap rate. So spreads have a number of factors. So you've got things like the operational costs of a bank and the funding costs. So that's why, for example, you typically see that the bigger lenders are more competitive on pricing, because they have cheaper deposits, and they also have kind of more operationally efficient teams that do kind of underwriting. They might have better technology. There's also other things in there. There's the strategy of the individual lenders comes into the spreads. So, for example, if I wanted to increase my market share, I might decrease my spread. So I was slightly undercutting the market in certain segments, so I got a better flow of business and increase my market share. That can be another area that impacts spread. So, for example, I think over the last few years, HSBC really wanted to increase their market share, so they were consciously pricing kind of under the market on certain segments to receive a higher flow volume of business. And then you also have other things. So one of the big things there, and this could come into play more if, I guess, things kind of really escalated, is one other big factor in how banks set spreads is their view of credit impairment. So what we essentially mean by that is the expected losses they take on their loans, primarily through people defaulting on their mortgages. So if you were to see kind of a real, uptick in unemployment as a directive and that's probably more of a kind of stagflation type case as a result of consequences from the conflict, and I guess a more wide global downturn, what you'd potentially see is an uptick in expected unemployment or a decrease in expected house prices, which then leads to an increase in credit impairments, which then causes lenders to increase their spread because they want to factor in that they're expecting more of those loans to go bad. Or in some cases, if it's a really sharp increase, you can just see people withdrawing from the market completely. So a good example of that was in kind of April 2020. Most lenders withdrew from the market completely at the start of COVID because they had no idea. That wasn't anything to do with spreads, right? With swaps, because the Bank of England dropped interest rates and, swaps came down quite a lot. But a lot of lenders withdrew because they didn't really know how to price that credit risk. Was this going to be that everyone was unemployed, everyone was at home, or the unemployment would go to 30, 40%, or 15%, or some crazy high number? In reality, it didn't get anywhere near that because of all the government support. But yeah, that can be a real factor if kind of things are in a real kind of state of economic crisis. Banks don't know how to price that credit risk element. And yeah, we've seen some examples over the last kind of 5-6 years of that.
Thank you for all of that. Before we move on to your business Keychain, you've actually met Mark Carney and Andrew Bailey, haven't you?
Yeah, I mean, I've been in meetings with them, been in very big meetings, but seen them at the Bank of England for sure.
Okay, so let's move swiftly on to Keychain. So you're causing a bit of a stir because it's very cool technology that you can bolt onto existing CRM. So tell us all about it.
Yeah, so Keychain, the bit we're really focused on is client onboarding and kind of all the tasks that the clients do with their advisor as part of the mortgage advice journey. So things like sharing documents, completing fact finds, medical questionnaires on the protection side, e-signing compliance documents. So yeah, what we do is we give firms their kind of own branded platform where they can invite their customers, kind of really tailor it to those customers to say what exactly they want them to do. The system as well will kind of automate key parts of or kind of all the tasks around that. So it will follow up on clients, send them reminders if they're missing certain documents. It will also do things like clean up all the documents for you. So convert them to the right format, take passwords off, rename them. And then we also use AI to check all the documents that come in from when clients are uploading them. So checks you've actually got the documents you've asked for, compares the information in the documents to the fact find, and then kind of runs through a load of other checks on the documents and summarizes them for you. So yeah, that's really the bit we're focused on, is that those kind of client facing parts of the journey.
Cool. And you're getting some good traction, I understand.
Yeah, no, it's going well. We're working with, at the moment, we've got 160 firms as customers. That's kind of fast growing. Yeah, always making improvements to the product. It's never ending journey to improve it, expand it to more transactions, more types of financial advice that our customers provide to their clients. But yeah, it's we're really happy with how it's going.
And where can people get hold of you to find out more?
Yeah, so on our website, we've got a link to book in a demo of the system. So the platform's really customizable to individual firms. So we like to find out about firms, their current advice process, and kind of see how it can best fit in with them. So that's kind of the easiest way to find out more. We kind of work with firms of all different sizes, 1 advisor firms, 10 advisor firms, 20, 30, 40 advisor firms. We do a free trial period on the platform, and then beyond that, it's a rolling contract. So we're very much kind of the mind that people kind of try out the products, try it with clients, see if it kind of adds value to their process, and then can kind of go from there.
And what actually is the website URL?
It's www.keychain.co.uk.
Awesome. Jack Rogers, thank you very much.